Hi, thank you everybody for participating today. Using Violin's digital platform and investor tools, I'm going to show you how to quickly and easily find worthwhile investment candidates. Going forward, I'm going to recommend one stock to buy right now. After the presentation, as mentioned, we have allotted time for questions and answers. To start, for those joining us for the first time, I want to provide a brief overview of who we are at Violin. We are a New York headquartered corporation that has been providing investment research for more than 85 years. Our flagship product is the Violin Investment Survey. This service is a unique source of financial information and is designed to help investors make informed investment decisions that fit their individual goals and levels of risk. The product includes data, information, and analysis on more than 1,700 equities that trade on the New York Stock Exchange, NASDAQ, and Toronto Exchange. It also includes economic commentary, easy-to-follow model portfolios, stock screens, industry-based analysis, and much more. This service, which is published weekly, is created by Violin's research department, which is comprised of more than 70 analysts, economists, data experts, and quantitative specialists. Our research is completely unbiased and independent. Unlike many Wall Street brokerage firms, Violin has no investment banking business with any company, including the 1,700 that are included in this service. Violin does not execute trades for its subscribers and therefore has no vested interest in whether our subscribers buy, sell, or hold a specific equity. What's more, our staff of professional securities analysts are not permitted to own shares of any company that they cover. As part of the formal presentation, let's start with an overview of the economic situation, as well as the Violin Research Department's view of the stock market. Obviously, this could help us with our search for a stock to buy right now. The following content are excerpts from our quarterly economic review, which was prepared by Harvey Katz, Violin's chief economist. After 3 straight quarters of solid domestic product growth to end the old year, 2018 has begun on a decent note, with the latest issuances showing gains in employment, a further pickup in wages, a 17-year low in the jobless rate, and high levels of manufacturing and non-manufacturing activity. The economy also is benefiting from lower tax bills for some individuals. Taken together, and factoring in the absence of serious early year weather disruptions, it would seem that GDP growth would hold in the area of 2.5% this quarter, following a succession of reassuring performances during the prior 9 months. Looking out on the current landscape, things appear to be in order, with a long-running business expansion, now 9 years old, seemingly on course to enter double digits in duration. This is not to say that things will be smooth going forward. That rarely has been the case during this lengthy but unimposing business upturn. Indeed, there are currently pockets of weakness, including the auto industry, where sales are easing off record highs, and within select retail categories, especially among purveyors of building materials, sporting goods, and health and personal care products. Also, industrial production flattened in January, as did factory usage, after a series of monthly gains, and our trade deficit widened again as imports rose. That, too, is hampering growth. Still, even with such outliers, the economy looks poised to press forward at a steady gait over the current 12 months and in 2019. As for the stock market, Wall Street's historic advance is now nearly a decade in duration. However, this year has been a headline maker, nonetheless, with 1,000-point swings becoming somewhat commonplace. Indeed, unlike the past 2 years, recent trading has been anything but orderly, with a series of price surges offset by a week of eye-catching reversals in early February that brought about the first correction, or a drop of 10% or more, in 2 years. In conclusion, although further gains, and even a full retracement of the recent correction, are possible, it is worth noting that the bull market's aura of invincibility has been shaken. As such, and with interest rates still on the rise, greater care in equity selection would appear to be warranted at this time. Now that we have a firm base in regard to the economy, stock market, and our outlook, it is time to find a stock to buy right now. As you can see, I'm currently at our homepage, www.valueline.com. On this page, you can access, free of charge, daily market commentaries, as well as general interest articles that are written by our analysts. Examples of such content are analysis of economic releases and quarterly earnings supplementary reports on the 30 components of the Dow Jones Industrial Average. I am now going to sign in with my username and password. After entering my credentials, I am taken to the welcome screen. From here, I can quickly get to many important areas of our website, including Browse Research, which is the main home for our core equities products. I can also head to our investor tools, as well as the home pages for our monthly stock selection services. That said, for this presentation, I want to start at the dashboard, which is the main landing page for subscribers. Each week, we provide useful statistics for how the Value Line universe of 1,700 stocks is being valued in the current market. These stats are published in the Summary Index, which can be accessed via the quick links. As you can see in the box on the left in the middle of the page, the median stock in our universe is trading at 19.1 times our 12-month share earnings estimate to September 2018. This is a good time to mention that Value Line's estimates are created completely in-house by our research team. Our PE calculation is also different than many other research houses. More specifically, we use a combination of reported figures and estimates for our P ratios, which we think is better than using a trailing figure or just estimates. For those of you that have participated in one of my previous webinars, you may have noticed that the 19.1 is below recent levels. True, the market correction has something to do with that, but I also want to mention the impact of the Tax Cuts and Jobs Act. Since that legislation passed in December, we have adjusted our financial models for the stocks that we track. Many companies in our universe were previously paying upwards of 35% in corporate taxes, but will now pay closer to the headline 21% figure. Needless to say, this will be a boon to profitability, and thus our PE multiples has come down. As for the 19.1 specifically, it is still somewhat elevated on a historic basis, but is consistent with levels reached during other multi-year bull markets. Let's also take note of the median dividend yield, which is just 2.0%. In addition, Value Line's 3 to 5 year median of price appreciation potential is 40%. We have been calculating this value, which is commonly referred to as the VL map, for decades, and recently it was at its lowest level ever reached at 20%. Again, like the PE, the market correction was involved. In addition, we are now factoring in lower taxes, which will help fuel profitability out 3 to 5 years. Just as important, we are now projecting results to the 2021-2023 timeframe. Previously, we were using 2020 to 2022. All told, at 40%, this is still well below the historical average. The VL map has proven to be a worthwhile indicator for evaluating the broader market, and a number of published works have focused on this proprietary metric. For those interested, I recommend a simple Google search. All told, and I doubt that this will surprise many of you, but Value Line still believes that the market is rather expensive, and like Harvey Katz stated in the conclusion of his quarterly economic review, greater care in equity selection would appear to be warranted at this time. Let's now go to the screener and find some candidates. This important investment tool can be accessed via the Find Ideas tab at the top of our website. Subscribers have access to more than a dozen preset screens, as well as almost 50 fields. I should also note that the screener possesses more than 200 fields in total, but those are only available with higher level subscriptions. I'm now going to run a screen, and using the information we've already discussed, my goal will be to find highest quality stocks with upside. I think that jives well with, and I quote, greater care in equity selection. Let's start with price to earnings. Simply click on the field and fill out the criteria, which can be done in a couple of ways. I can use the sliding bar to set my range, or I can simply type the values in the from and to boxes. As mentioned, the median is 19.1, so I'm going to focus on stocks that are trading below that level. Reason being, I want to avoid stocks trading at lofty and likely unsustainable PEs. I also want to remove stocks that are trading at very low multiples, which often implies that something, besides earnings, is impacting the stock. That can be a legal matter, recent management turmoil, or signify an industry that is currently out of favor. Thus, I'm going to set the low bound to 5. This will also remove unprofitable companies. Click on Filter. Okay, that's a good start. Actually, this is a good time to mention that, at present, more than 4,300 stocks in our database have earnings, but with a few clicks, I was able to narrow it down to under 1,000. Next, and importantly, I want to get rid of lower quality stocks and make sure that my selections provide some defensive properties. There are numerous risk and volatility measures, with beta probably being the most popular. However, I'm going to utilize Violin's proprietary safety ranks. The safety rank measures the total risk of a stock and is arranged on an easy-to-understand scale of 1 to 5, with 1 being the most stable issues. I want to highlight the fact that stocks ranked favorably for safety have, in the past, held up far better than the broader market during corrections and downturns. For this, let's focus only on stocks that have earned the highest safety rank of 1. These are the most financially strong companies, and using this field will almost always weed out smaller market capitalization companies, which often experience significant price swings in volatile markets. I now want to make sure that the stocks we focus on are expected to grow its bottom line over the near and long terms. The projected 3 to 5 year EPS growth rate field will work well for this. I also want to highlight that Violin is one of the very few research houses that provide financial projections that far out. We think that these estimates are of great value to our subscribers since they show a long-term trajectory of the company. A lot of times, a company will introduce a hit product, but it may be short-lived. These projections will show whether a business has long-term staying power or if it's just a passing fad. So for this field, let's set the low end to 8%, which is a healthy level of annual growth, especially for large, mature companies. Lastly, we touched on dividend yield earlier, and the median yield for our universe is 2%. The majority of income investors are not going to find 2% attractive, so I'm going to set the low end to 3%, or 1 full percentage point above the average. In addition to income, dividend stocks tend to hold up better in down markets, so this is another way of adding a quality component to our screen. And there you go, 5 candidates. According to our criteria, these stocks are reasonably priced, are the safest on a relative basis in our universe, appear poised to advance earnings at a good annual clip, and offer a meaningful yield. All 5 of these stocks may well be good additions to a conservative equity portfolio, but in my opinion, Total SA, ticker TOT, is one stock to buy right now. Before I go any further, please note that screens can be saved and revisited later by utilizing the button at the top. Let's now get some more information about Total. Clicking on the company name will take us to the equities digital report, where the data, information, and analysis is arranged in more than 15 modules or boxes. These modules can be moved around, resized, and hidden, so you can create your own customized stock report. For instance, perhaps the 3 to 5 year projections are most important to me. I can simply click and drag that box to the top. I can also resize it. And let's say I want the commentary to be second. Once I alter the presentation to my liking, I can save the changes from the sliding horizontal action bar. The next time I come to this stock report, it will look the way I set it up. To start, let's get some quick information about Total, which is available from the Business Overview module. The France-based corporation is one of the largest publicly traded energy companies. Its daily oil production exceeds 1.3 million barrels, and it employs more than 100,000 individuals. Importantly, Total trades on the New York Stock Exchange as ADRs, or American Depository Receipts. Thus, the dividends are subject to foreign withholding taxes. How has Total stock been doing of late? From the valuation module, I can quickly pull up a stock chart. The yellow line is the equity's performance. As you can see, it has been trending higher over the past couple of years, but is still trading well below the highs reached in 2014. I'm now going to take a look at the Analyst Commentary to get some information in regard to what is going on at Total. Senior analyst Nick Patricus stated the following in his most recent report. Total SA had an exceptionally good year in 2017. The international energy behemoth reported full-year revenues of $149.1 billion, a 17% increase year over year. The bottom line advanced nicely as well to $3.36 per ADR, despite a softer than expected fourth quarter figure. Indeed, there was much to applaud in 2017. The company invested more than $14 billion during the year, trimmed $3.7 billion in expenses, and significantly lowered its cost per barrel of oil equivalent to $5.40. Operating cash flow from both its refining and production arms were solid. Looking forward, further cost savings of around $4 billion and organic investments are on tap for this year, while production metrics, such as 6% projected growth in 2018, should also continue to strengthen. I now want to show you our classic PDF report, which is included with a digital subscription, and provide some additional analysis on why we think TOT is a good choice. In the statistical array for 2018, we estimate share earnings of $4.45 per ADR, which would represent a year-over-year gain of 32%. That hefty rate that we envision will be fueled by a 16% sales increase, wider margins, and a lower share count. On that last point, Mr. Patricus also discusses management's shareholder-friendly actions, which includes a 10% increase to the quarterly dividend payout and the company's sizable stock repurchase plan. All told, we think that Total shares are one stock to buy right now, and they tick a lot of boxes. They trade at a reasonable price to earnings multiple, are top ranked for safety, profits appear poised for significant growth, its dividend yield exceeds 5%, and the company should continue to return cash to shareholders. I hope you found the method for finding a stock to buy right now interesting, informative, and efficient, and I encourage you to utilize the screener in your next search for new equities. In addition, though I didn't cover it in this presentation, Violin also offers subscribers watch list and alerts tools that can help you keep up to date in regard to your current holdings, as well as prospective stocks that you are considering. Lastly, I know that this process does take time. That is why I want to close with introducing you to Violin's model portfolios that can help alleviate the work of finding worthwhile investment candidates altogether. Part of the Violin Investment Survey is the weekly Selection and Opinion newsletter. Along with economic and stock market commentary are 4 model portfolios. The Selection and Opinion can also be accessed via the quick link. Each model portfolio has a different investment strategy, is actively managed, updated each week, and always contains 20 stocks. The portfolios are overseen by senior research analysts. Portfolio 1 is best suited for aggressive investors and focuses on stocks that are expected to outperform the broader market over the year ahead. Portfolio 2 should be of interest to more conservative investors and focuses on dividend-paying stocks that also offer worthwhile appreciation potential. Portfolio 3 chooses equities with long-term price growth potential and, of course, is best suited for patient investors. Portfolio 4 is filled with stocks that possess above-average dividend yields and is for investors seeking current income. We have a great number of subscribers that follow these portfolios. For those interested in possibly adopting one of these strategies, here are a few helpful details. New positions always amount to 5% of the market value of the respective portfolio at the time of the trade. Any dividends received are simply taken as cash. They are not reinvested. Lastly, the portfolios are not rebalanced. All told, the model portfolios represent some of the Violin Research Department's best investing ideas, and we recommend that you read the analyst-created content and look over the portfolios for possible additions to your holdings. Subscribers looking for a total investing solution are also encouraged to check out our premium monthly selection services, Violin Select, Dividend Income and Growth, Special Situations, and Select ETFs. If this is something that sounds up your alley, call 1-800-VALUELINE for a free sample report. We also offer free trials on our website. This marks the end of the formal presentation, and after a drink of water, I will tackle your questions. Give me 1 sec to scroll. Okay, first question. I have a paper subscription for the Violin 600. How do I set up an online account? You can do that by calling 1-800-VALUELINE, and a representative will help you out with that. You have an option to keep the print and add digital, or just move to digital. And they'll work that out for you as far as length of subscription and the cost, etc. Someone asked when they could play this back. It will be added to our website and YouTube channel within 48 hours. Can you discuss the tax implications and strategies for a private investor? Well, as your individual taxes, obviously that's going to differ depending on your income and all the other costs, interest on real estate, etc., where you live as well. We're here in the New York City area, so we have an added city tax. As far as investing, the capital gains taxes and dividend taxes haven't changed. And as far as looking at companies to buy prospectively, I would definitely take a look at the tax rate that we're estimating, but also look at how companies report, especially their first quarter, which will come out in April or May, just to see how that really worked out. A lot of companies have announced, yes, they'll start now paying that 21% number, but that will depend on where their income comes from. Internationally, they might pay more, they're less, etc. So it's something to definitely keep the tabs on. But as far as picking stocks, yes, it'll make earnings in 2018 look good versus 2017 when they had the higher rate, but over time that's going to smooth out. So I don't see it really being a huge catastrophic difference to your process. Are all search tools covered, available for 600 subscriptions? Yes. If you have a digital subscription, you have access to the screener, watch list, and alerts. But please note that you'll only get information on those 600 companies. My presentation today covered the 1,700 in the Violin Investment Survey. For those of you that don't know, the 600 are the more or less largest, most heavily traded stocks from within the 1,700 stock universe. They're overwhelmingly large cap, which we define as a market cap above $5 billion. Next question is, why did you recommend TOT if it had a timeliness of 3? I definitely look at the timeliness when I'm looking for stocks here, and it is one criteria I use, but it is just one criteria. I really like total from a lot of other perspectives, especially during this volatile time in the market. Another question on timeliness. What exactly does timeliness mean? It means that by our quantitative strategy, it will outperform the market over the next 6 to 12 months. It takes into account a whole load of historical data, and it has proven to be very useful over the time. And like I said, I do use it in my criteria, but I don't think it's a be-all, end-all. No metric should be the sole focus of an investor. Can you explain more about the taxation on dividends for ADRs? Sure. So as I mentioned, total is based in France, and you have to pay, I believe it's a 15% tax on the dividends you receive. That rate does differ depending on what country the corporation is domiciled in. Why did I select total from the 5? Before or as I was setting up this presentation, I looked at each one individually, and total just simply ticked more boxes than the others. But like I said, I think all 5 companies can be considered. Does Total's retail presence give it some added diversification compared to Exxon and Chevron? It definitely helps, but those are also, very strong energy plays. I like Total, and those other 2 didn't meet the criteria. But there's nothing wrong, obviously, with taking a position in those other energy stocks. Is selection and opinion included in the 600 subscription? No, it is not. You'd have to upgrade to the Violin investment survey or potentially buy the selection and opinion as a separate subscription. And that's also something that the people at 1-800-ValueLine can help you with. How accurate has ValueLine been on projections in the past? So I'm assuming you're referring to either the company's individual earnings projections or the ValueLine median appreciation potential. We have done a few kind of cursory, we've explored the projections, and obviously company CEOs can't get their current earnings correct, and we're going out 3 to 5 years. It's why our target price range is a band, not just a price. And our analysis has proven to be quite worthwhile. But yes, sometimes there's wide swings, or a company makes a massive acquisition or divests a business. So projections are hard to really say that they're X% accurate. All right, more questions coming in. Does ValueLine have a market forecast for the S&P 500 for year-end 2018 and 2019? No, we do not forecast growth of the S&P. Although in our Dow forecast, we do forecast that index. And that was written in the S&O as a special feature a few weeks ago. Last question that I see, do you factor in the relative P ratio when looking at a stock? Yes, absolutely. I look at relative P to see how expensive the stock is relative to our 1,700 stock universe. Relative P is wildly important when trying to evaluate a stock. All right, let me take another quick scan, make sure I didn't miss anything. Oh, one more just came in. What is your #1 selection criteria? Personally, he asked if it's safety rank. Safety rank would definitely be high on my list. But like I said with timeliness, I don't think it's a great idea to look at any one metric. A stock can look good from any actual selection, but look horrendous from others. Dividend yield is actually a good example. I mean, there are stocks that offer a 10 or 20% dividend yield, but the chances of a pay cut are probably massive. So you really need to look at everything, or at least several factors. Can you discuss the capital structure box for this selection? All right, well, let's take a look. Here's the capital structure box. As you can see, the company has admittedly a hefty amount of debt. That's $41.3 billion, but it is only 27% of capital, which is a very reasonable percentage. And as you can see from the interest coverage, profits easily cover interest. They have, for a company this size, they have reasonable pension assets and obligations. And as you can see, they have 2.5 and change billion ADRs and a market cap of 144 billion. A little less than half of the debt is due within 5 years, which we don't see as a problem. They generate plenty of cash to cover that. I hope that answers that question. Last question, and I apologize, I'm not actually familiar with, does Violin offer screening configurations? If you're referring to preset screens, meaning screens that we think are valuable, yes, but I've never seen the word configurations used for that, so you might be referring to something else. Actually, this is a good time to mention, if I don't get to your question or you want more information on a question, you can email me at igendler@valueline.com. That's the letter I, GENDLER @valueline.com, and I will expand on my answer if I didn't get to it or I didn't cover it in greater detail. All right, last question. What will be the impact of batteries on the oil market in the future? Loaded question. Obviously, if electric cars take off, that's a reduced demand for gas, obviously. But there's a whole host of applications for oil. And yes, maybe it will be phased out over decades, but I don't think that's going to be a real concern in the short term. Not that many people are buying $75,000 Tesla cars. I'm curious about leases, uncapitalized, and annual rentals. To be honest, for this, I didn't go into that kind of granular detail on total. That's a question to email me, and I will have Nick Patrikis respond to it. I don't want to make anything up for this. All right, well, that's the end of the questions. I want to thank you so much for attending. Take care.